what do we have? We have full house. This is, whoa, 70. Look at the advanced decline ratio. Look at the surge on the Nifty, and a market which was really large cap stocks which were lazy and they were in hibernation. I think the tortoise, which we call them, the tortoise has become a bull, and they've started walking at the pace of a rabbit today. So large caps is where all the action and excitement is. Blink of an eye and it's just magic. New high, and it's a new high which has been made on style, and you made a new high which now is way past the previous high, which means that there is going to be a huge gap up start, and then let's say what happens after that. Second, banks. Banks is where the turn is evident. Large cap private banks across the board are in some kind of a it's a great start for them. Now let's look at Adani group of stocks, please, one by one. Adani Enterprises, Adani Ports, a whole host of Adani group of names, and all of them are up anywhere between 5 to 10%. That's where the excitement and action is. Now let's look at defense, railways, construction, PSUs largely, because that's the exciting space, and that's where I guess the binary risk of a 2024 election cycle has got completely diluted. So that's where I think the excitement is going to be captured. HAL, it's up tick there. Look at, we'll have to change the graphics perhaps slightly more quickly because a lot of rates are changing and a lot of exciting things are happening. Just pardon me, the wall is just getting slightly lazy because so much of price change today is just having an effect. BEL, BHEL, Kochi Shipyard, Mazgaon Shipyard, all the anything and everything which is in the railways and which is in the defense space, I think is really is off to a great start. Aisha?
Yeah, it is. You pick up any stock within the PSU pack. Forget just defense and railways. Across the board, you are seeing a whole lot of green really built in on these names. But let's also focus on what the large caps are doing. Of course, I can see Adani Enterprises, Adani Ports, and I think for Adani Ports, the cargo volumes for the month gone by did post a handsome uptick. So there's that further fillip in terms of news flow as well for Adani Ports. But HDFC Bank, Reliance Industries, ICICI Bank, Infosys and ITC, the large cap underperformers, they also are moving up, which is why you're seeing a bigger medium move on the index. So it was a 1.5% move coming in for HDFC Bank, or nearly 2% actually, 1.5% up in the green for Reliance, and then ICICI Bank also over a 2% move is what that stock is currently seeing in trade. So in tandem with the rest of the market, these cases are not really standing solo in the queue. They're all on the green side right now. Let's address some newsmakers as well while we're at it. Hero MotoCorp, the total November sales saw an uptick of about 20.6% on an overall basis. The domestic sales have risen about 25.4%, 2% higher for Hero MotoCorp, which has been the most charged up along the stocks in this series gone by. Eicher Motors as well, Royal Enfield sales have seen an uptick of 13%, exports uptick of about 2%. That's looking strong. There's of course Tata Power. They're looking at acquiring Bikaner-Neemrana transmission project. The estimated cost is around 1,500 odd crore rupees. Tata Power holding up 2% as we speak right now. I want to now address what's happening within the entire newly listed universe. What is Tata Technologies doing? IREDA, Gandhar Oil. What are these new debutants from the week gone by up to? Tata Tech finally seeing some signs of a crack build in. That stock is down 4.5%. IREDA is currently higher by 3% as we speak right now. So good start, a lot of expected lines. Kunal, what's your first reading?
Yeah, I think it's a very good start again for the index. We are above that 20,500 mark, which is again a good psychological hurdle and should also probably fuel more put writing onto the index. So hopefully that 20,500 mark, if we sustain about those levels for the first hour or so, then I believe that we could see a stronger put writing that could act as a base for the index going forward. In terms of the opening trade, Tata Motors is something which looks attractive and would be keen to buy the stock even at current levels of 700 plus.
All right, let's get in your take then. And you've got all Nifty 50 stocks, Naresh, that are in the green. Adani stocks leading the way. Anything particular that's catching your eye on this stellar Monday morning? And run us through your first trade.
So overall, the whole market looks interesting given the breakout move. Would be waiting out for a dip on ICICI Bank in the day to buy. like the stock, that could be the one which could actually lead and go towards a new all-time high quickly.
All right, Sanjeev Prasad joins us now, and let's take a conversation forward and let's understand the most important thing which we all should focus on. While we can get excited about the market rally, the upswing in the market, the comeback in small and mid-cap stocks, but what about risk and margin of safety and future returns from the current level? Sanjeev Prasad, good morning. Thank you for joining us. There are smiles all the way, so let's start the interaction with a smile on your face.
Party time, man, anyway.
Okay, now that we've got this, smile captured on camera, do you think the bulls will continue to smile, or it's time now to hold back your horses and say that this is euphoria, and euphoria rarely makes money?
Well, it depends on which part of the market you're looking at. So if you're looking at the very large caps or the mega caps, valuations are still pretty reasonable, and that's the part of the market where we have been highlighting investors to focus on incrementally over the last 2-3 months now. If you look, and also the financial sector space, which has been a big underperformer, and valuations are actually very reasonable there and even attractive in some cases. Now, if you look at the rest of the market beyond the mega caps and the financial space, there isn't, to be honest with you, much value left over there. So either the consumption names, pharmaceutical, IT are probably fully valued to fairly richly valued, I would say. So the scope of making money from here seems to be somewhat limited, a bit about whatever short-term euphoria may be there, and where the stock price may go up in the when they go in the short term. And lastly, if you look at the investment space, as also some of the low-quality mid-caps and small caps, I mean, there is clearly a bubble market out there. Lots of excitement linked to investment cycle, which we completely agree about. There will definitely be a positive structural investment cycle. There's no doubt about that. But the kind of valuation multiples investors are already paying for some of the names, I don't know, it clearly doesn't make sense. In the short term euphoria, they can continue rise, but I don't know whether you're going to make eventually money in some of the names in the next 2-3 years. Many of the stocks could probably be lower than where we are currently. Or even if they go up much higher in the short term.
I want to address the lagging part of the market. And, while all indications of premiumization, urban consumption are indicating towards further and further uptrend, the rural segment of the economy continues to languish. I wanted to understand whether the state election verdict or the run-up to 2024 would mean higher rural spending, and would that then translate into rural numbers picking up?
Well, I don't know whether the government needs to do anything incremental looking at the thumping mandate which the BJP has got. If let's say, it's a clearly hypothetical situation now, if it lost all the state elections, the 3 major ones in the heartland, then maybe the government would have been pushed to course correct and do some incremental spending through the revenue expenditure route. But looking at the endorsement of people in general, the 3 in the heartland states would probably reflect the mood of voters in other similar states also. So it is pretty clear now, whatever the government done between its 2 terms, the common person, average household is very, very happy with whatever the government delivered. And to be and to give credit to the government, if you look at the last 7-8 years, the quality of life of an average person improved dramatically, I would say. Last 2-3 years may have been a bit of a struggle, but obviously can't hold the government for it, given the fact that obviously a lot of momentum on employment, etc., got delayed because of COVID. Yes, there is some struggle as far as rural economy is concerned, but our take is that over the next 3-4 quarters, things should improve here, given the fact that as investment continues to move forward, you will start seeing some trickle down benefits for the rural economy also. And more important, keep in mind the fact that prices seems to have stabilized finely. You had pretty high inflation across basic goods and products over the last 4-5 years now. I mean, obviously nothing to do with, again, government policy, more to do with very sharp inflation of the prices. Now the raw material prices are starting to come down. There is no necessity for companies to raise prices further. So based on a combination of hopefully some improvement in wages as we go forward, linked to job creation and flat product prices, the liquidity situation, which was very badly affected in the last 2-3 years, that should start getting addressed. And hopefully that should result in rural consumption coming back.
The general view with everyone now is that kahan jayenge FIIs. It's a matter of price and it's a matter of risk. They will be forced to make a comeback. Everyone is of the view suddenly in the market that they will come back and they will come back and they will buy the same stocks which they've been selling in 2022 and 23. Is there merit in thinking on those lines?
I guess some merit, because many of the FPIs have been, sitting on the sidelines, waiting for a correction in the Indian market to get in. Once again, some of them had, gone underweight India in late 2022, taking a more positive call on China because of the opening trade, which never really played out as per expectations. So since then, a lot of investors have been sitting in China, hoping for a rebound to get out of China, waiting out of India, waiting for a correction to get into India, and both haven't really happened. So the frustration levels have obviously gone up for some of these investors, and who knows, they will finally capitulate, throw in the towel and look at India more favorably, despite the fact that obviously valuation become richer compared to when they sold off. Having said that, the large caps are still looking fairly interestingly valued. Some of them are still pretty attractively valued, as we discussed, large cap banks, Reliance, etc. So maybe some of the investors, probably re-enter India through the same, stocks, financial names, few other, large caps with valuation are more reasonable. And anyway, those are the stocks they will look at. I don't think they're going to be doing, some sort of a deep dive into the mid cap and small cap space, where valuation obviously become fairly, in my view at least, for some of them. And given liquidity and valuation concerns, they would probably, look at the large caps, as and when they come into the Indian market once again. So yeah, I would be too surprised if some of them, come back in the market. Maybe they were hoping for a correction in the market based on some negative outcome on state election results. That's obviously not going to happen now. So whatever the probability was there of, the BJP not forming the next government, I think that's also, out of the window for now at least.
What are you telling your global investors? Come now or come after May 2014, but you will get the markets higher by 5-7%?
May 2024, you mean? No, see, we have been telling pretty much the same thing to investors that look, valuations of the large cap, mega caps are still fairly, interesting. Many of them are reasonably valued. So if you want to come to India, you might as well, come now. See, anyway, at the end of the year, so I don't know how many of them want to take some dramatic, changes as of now. So over the next, few weeks, assuming nothing else happens in the world, as and when they come back from the holiday, some of them may, review the portfolios, look at the fact that, the struggles with China continue. The incremental news out of China continues to worsen actually, default rates among, consumers continues to rise. Many of the companies, especially, the local government finance vehicles are very, very overstretched now. So doesn't look like there is anything going to happen over there. So I don't know how long can investors persist with the China trade, which doesn't seem to really play out. Ultimately they may be forced to come back to India, and I guess no point waiting, to be honest with you now, given the fact that more or less it looks like the politics is not going to change between now and May. Looks like at least looking at the results of the state election. So you might have to bite the bullet and come in now.
Are we in for a real comeback in FI dominated stocks? I'm putting you in a spot by asking you these tactical questions, but that's what I think the moot point is, that they will come back and they will come back before elections.
Possibly, I can't comment for the either way. They can take their own decisions, but looking at all that has transpired, given the fact that some of them were underweight, some of them were hoping for a correction to get in. Everybody likes the long-term story of India. People want to put more money to work into India. So now that whatever little uncertainty was there with respect to election results, and the probability of a correction in the market has obviously gone down dramatically. Probably it makes sense to jump in now rather than wait for something else to happen, which may result in a break in the market, and give an opportunity for investors to come in.
on board. Thanks so much, Sanjeev, for joining in. That's the outlook. Rural economy should improve over the next few quarters, and FIIs will be forced to come back to India. A quick check-in on the rates on the screen: 20,561, sitting pretty, healthy advance decline ratio, and the Sensex soaring by 1.5%. Let's move right on and put the spotlight on Tata Chemicals. Lots to talk about with respect to the revision in soda ash prices, as well as their volume growth and FY24 outlook. R. Mukundan is the Managing Director and CEO, now joining in. Thanks so much for taking time out. Why don't we start by talking about the price cut that had been announced for soda ash prices? Walk us through the rationale behind it. Would it mainly be attributed to the higher imports from China and demand issues?
China is not in the scene at all. So China numbers usually track about 9,000 odd tons, and it's been just there, in fact, tracking down. China is having inventory problem. In fact, China is importing consignments. So the real issue is what's playing out in Europe. I think we missed the bus in terms of, we are not tracking Europe enough in terms of chemicals and what's happening to chemical stock. Especially Europe accounts for almost 6 to 7 million tons of demand. And about 4.5 million tons is domestic production in Europe. And that is really challenged today. And that's challenged from two fronts. I think there's been demand reduction in Europe. And secondly, I think the high energy costs because they don't have access to the cheap gas anymore coming in from Russia. And thirdly, the carbon dynamics, the way they are playing out in that market. I think that entire capacity is now is in the long term, I would say, difficult position. Because of that, what really has happened is also because the customer demand has fallen in, that there's a surplus material which is coming in from Turkey. It is not really coming in from the Turkish material, which used to land at about 10, 15,000 tons a month, has jumped up to 40, 45,000. In some months, it's almost 60,000. I think that's really the one which has caused a bit of dislocation. But if I were to sort of say, listen, I think this is a short-term materials are landing here. What would happen in the long run? I think really Turkish material, its real home is Europe. That would stress or challenge the synthetic capacities there. And wherever natural capacity has come, the synthetic capacities in close proximity have found it difficult to compete, and they've had to fundamentally, if you look at North America, when 6 million ton of natural capacity came on there, it completely wiped out the synthetic capacity. We do believe some similar trend in Europe is going to happen, and hence I think the real story which we need to watch is what's going to happen in Europe. If you look at our own strategy in Europe, we used to have close to 1.5 million ton of capacity there, and in fact we're down to 300,000 ton. We have done it structural adjustments over the last 6, 7 years, 10 years. We took out the capacity in Netherlands and actually shut it down more than half the capacity in UK, because I think we tend to be a little ahead of the market. And I think we are going to see play out is the European story. And I think that's really what's happened. This is a short-term adjustment. I think we're at the bottom end of the cycle. As I was mentioning to some of the investors in my investor meets very, very recently, that we are probably, at that time, we are not taken the cut. It was, I said about $10 or so, or $15 at best from the bottom end of the cycle. And we finally have taken the call to correct it to make sure we stay competitive to imports, especially that which is landing from Turkey.
Okay. Morning, Nikunj also joining in. If I look at the soda ash market in India, soda ash does not get imported. I mean, it's a commodity which is locally produced. Now in India, demand vectors are not that bad. Yet you've taken a price cut, irrespective of what's happening in the global market. Why is the domestic market coming under pressure?
So, Nikunj, I think let me correct this. India actually is a net importer of soda ash. We almost import close to 1 to 1.2 million tons of soda ash. It is a monthly import ranges between 50,000 in the low end, where the demand is completely balanced worldwide, going right up to 80, 90,000 ton. And I think this has been the trend for almost, not just now, but for many, many years. And our pricing in India tends to be import parity pricing. So we tend to sort of price our products. So Indian prices tend to be around, let's say, 280, 290, when the international prices are somewhere around 215, 220. So there's about $50, $60 increase which we see because there's a whole host of goods getting cleared, the local transportation, and then finally the custom duties and all put together. So that's been the normal trend, and India will continue to be a marginally import dependent market with about 80% domestic supply and maybe 20%, 15 to 20% imports.
Okay, I stand corrected. I was looking at the presentation from some of your peers, and maybe I got confused on that. Given that the important raw material pricing, which is in your case coal, is still at a challenging level, do you think, irrespective of what happens to demand on the raw material front, the pressure will continue?
No, not really. See, as I said, there's a structural story unfolding, Nick. When we can miss the the let's say medium term picture for what is happening short term in terms of what monthly or quarterly numbers which are moving around. The big picture is that I think the China issue we need to be very watchful of the demand, whether the internal issues in China sort themselves out. More importantly, I think the big capacity of 5 million ton of natural ash which came in China is probably going to challenge the internal synthetic market. And also Chinese synthetic production, 40% of that is through a very unique process called Wu process, which is more, let's say, expensive because they actually use ammonia as an input rather than using ammonia as a catalyst, which we use. So I think that 40%, which is almost like 10 to 12 million tons of capacity, I think is something internally will resolve itself over a period of time to balance itself. The more importantly, I think it's the big picture of the European chemical production, especially of energy intensive products like soda ash, which will continue to be pressured. I think we are having early signs of these with few of the producers almost announcing structural adjustment of 25-30% production reduction in some of their sites. And I think that this story will play out in a couple of years. The only way the story can reverse is if there's an access again for cheap Russian gas, which I really don't know whether it's going to happen. So if you say that the current situation continues, I think we are in a situation where the European production, which was driven largely by gas as energy source, which was piped into Europe, now has to depend on LNG shipped in from Qatar or from and the reason I say that is we ourselves know our own cost structure in UK. So we have done structural changes in terms of moving to value-added products because out of 350,000 ton, we'd make about 120,000 ton of bicarbonate, which is much higher value-added product. But other players, they have a 4.5 million ton capacity there. That's the real one which is going to play out. And if that plays out in the right time, I think the world markets are pretty fairly balanced today.
Okay. What is Tata Chemicals doing to reduce their dependence on soda ash? Because ultimately it's cyclicality which is at play. What you want to do is that businesses which are far more structural.
So I think we've had a pretty deep debate about this, and I'm glad that you asked this question. We do think the soda ash vectors for growth continue to be robust. So we are putting 1 million ton capacity spread across 400,000 ton in US, about 250,000 ton in Kenya, and about another 250,000 ton in India is getting commissioned the next March, half of it in December, another half by March. We're adding one more 250,000 ton capacity in India and put together close to about 1 million ton. But this investment we are making actually is not just for growth, it's also to decarbonize. In US, we are converting, while we are putting this additional capacity also to 100% natural gas. In Kenya, we are having a PPA agreement which we are signing for solar and wind hybrid. In India, we are going to be adding 30% biomass to our fuel mix. So it's both growth as well as debottlenecking as well as decarbonization. And the next phase of growth from the 5.5 or so to go to 8 million ton, the growth primarily will be split half between India and US. For which we will go through environment clearances and other approvals, which process has already started. And that will come after about 26, 27. So soda ash growth, we will continue to pursue because I think the market is having a long-term positive trend. And also the structurally weak companies will go away from the market, as I mentioned, the challenged ones in various geographies. Now, your question is absolutely right. We were about 50% dependent on soda ash. I think that cyclicality or maybe the dependency has increased to close to about 70% in our revenue mix, and that was because we sort of sold the fertilizer and we also demerged the consumer business. And really, one of the vectors we are doing is within the sodium chemistry, we are accelerating the growth of both salt as well as bicarbonate. In fact, bicarbonate capacity will grow disproportionately, and also, but that can't take care of the dependency or reduction of soda ash over a period of time. We have to grow our agrochemical business in our subsidiary Rallis. We have to grow our silica business, and both of which capital investments there are on their way. Rallis has just commissioned a MPP multi-purpose plant the last quarter, and that's already 40% fully booked. And I think they will be reaching full capacity utilization in about another 9 months or so. And our silica expansion by about from 5,000 tons of tire grade to about 13,000 ton should be getting completed by December this month. And then the board has already cleared to take that capacity to 30,000 ton, which investment we are waiting for consent to establish from the government. Once it's given, I think it's about 18-month investment cycle. So we have to grow other products, and clearly the board and the company management, we are all focused on that. But that doesn't take away the fact that we had 3 engines running the company. 2 of the engines were taken through management action for other purposes. We now have 1 engine. We have to add another engine, and that's what we are doing.
Final question, how far are you away from that real breakthrough in the battery technology? That's something everybody wants to know. You're working on it, we've spoken about it, but realistically, will it happen next financial year?
It's not a technology issue, Nikunj. I think it is mostly an issue of a commercial arrangement to be worked out. As I mentioned, the battery itself will be made by a Tata Group company called Agarthas, which is fully in place. They are progressing well, and you would hear from them directly in the news as they make announcements. And we are engaged with them to be a supplier of choice. And if they do select us, I think it is in. Otherwise, we will have to look for other opportunities to enter. But we are fairly confident that we would work something out in the area of battery chemicals. We are pretty much focused on that, both cathode active materials as well as electrolytes. But this is a game one needs to be in the game, impatient. In addition to that, we have not stopped any R&D efforts. These are Horizon 3 opportunities, like, for example, in sodium chemistry, we've just made the coin cell. We will continue to do the development work on that. We are long-term bullish on this, but we'll continue to work. But it's a more of a commercial arrangement being worked out, and we will work with our potential customers as well as we can, as we have worked with almost all products with all our customers.
Sure. Mr. Mukundan, great to have you on the show. Thank you so much for taking the time out and joining in today.
Thank you.
Okay, we'll take a very quick break. That's Tata Chemicals in trade for you. What's happening with the rest of the market? We're latching on to our gains. 20,650 nearabouts on the Nifty futures. Adani Enterprises, Adani Ports, HPCL, Manappuram, ACC. These are your big winners from within the F&O universe. When we come back, we'll chat with Vinod Agarwal, talk about how their monthly sales numbers panned out. Back with first trades, right here, ET now, and the first trades are holding up just so smartly. A pop-up after those state election verdict, and the market has taken it with a full thumbs up, holding on very, very nicely, 20,577, and across the board participation that is really coming in. You can't really pinpoint any concentrated pocket of weakness in this roaring market. But let's welcome on board Vinod Agarwal from Volvo Eicher and talk about how their monthly sales numbers were and what's been their reading. Mr. Agarwal, great to have you in ET now once again. And from the numbers, one can see that unfortunately there wasn't much of a festive cheer. What's been your reading on how the trend is likely to pan out from here?
Yeah, after an excellent festive season, I think the month of November was a bit of dull. But that's not a concern, because we have to see that in the month of November, there were a few holidays, and of course, there were elections. So therefore, there were a lot of distractions. And but as far as the industry is concerned, we are expecting the industry to continue the growth path, and we are expecting December to be much, much better. Even though on YTD basis, still the industry is all right, because heavy duty trucks are growing by 14%, on YTD basis for the industry. Buses are growing very well. Buses are growing by 34% on YTD basis. And of course, exports were better in the month of November, even though YTD exports are still down because of the South Asia problems. But we expect the exports to be better in last quarter and in December. And light and medium duty trucks and light duty trucks, I think that has been stagnant for this full year for first 8 months, because last year itself was bumper for the light and medium duty trucks. So therefore, overall, I would say the industry is doing well. Overall, YTD 3.5 ton and above industry that has grown by around 9%. And as against that, YTD we have grown by around 12.5%. We are at around 52,000 sales in the first 8 months. And of course, we are doing relatively better, and our market shares are also better in all the segments.
Dealers as well are indicating that we could see a pickup in CV demand from January on the back of increased freight rates. Can you give us a sense as to how you see the scenario playing out and what you're looking at when it comes to projections for demand?
I think last quarter and the month of December also, we are expecting it to be very good, because still, if you look at the overall industry figures, we are still away from the earlier peak sales, especially in the heavy duty trucks. We are still down as compared to the earlier figures of 2018-19. And there is a lot of pent-up replacement demand because of better productivity and better efficiency of the new trucks. So therefore, it makes a lot of business case to replace the old trucks because of better infrastructure. The trucks which are maybe 4 years old or 5 years old, they are not able to deliver the efficiencies which are expected from the transporters. Therefore, more and more replacements have to come. So that is one fundamental reason of growth. The second fundamental reason of growth is the infrastructure investments. We see the continued focus from Government of India. And third is economy. We have seen that the GDP outlook is even better for the year. So therefore, there is no reason why the industry should not do well. November month, of course, was a exception because of a few reasons. And we are expecting the industry should come back fully in the last quarter, and December also should be better.
Okay. I'm going to just draw your attention to a very basic point, that road quality is getting better. If road quality is getting better, which means that the requirement for high tonnage trucks would increase. So do you see a shift happening there, which could be a decisive trend where the medium tonnage trucks or CVs may actually start seeing a decline, and the high tonnage trucks, which are more efficient and carry more load and now have better roads, they could kick in?
Logically, what you are saying is correct, because we already see the migration happening towards high tonnage trucks. If you look at within heavy duty trucks, the growth in the tractor trailers, that is more than 40%. So tractor trailers are already growing faster than the smaller or rigid trucks or the smaller trucks or medium duty trucks. But at the same time, when the efficiencies are getting better, there is more and more hub and spoke model. It also means that there is a need to replace faster. So therefore, that's what I said earlier. The replacement demand is very strong, and the entire population of old trucks, which are BS3, BS4, they will come for replacement. So that is why you will see strong demand.
We have seen a raw material inflation impact on most of the auto sector per se. Given that things are now easing out, could we be in for a year of price decline or margin expansion?
I think this is a very, you can say, fundamentally, if you look at the CV industry as a whole, CV industry didn't have the pricing power, and the industry has suffered a lot because of the very heavy discounting. And if you go to a little bit of history on inflation, the steel prices, which used to be around 37, 38 rupees per kg in March 20, they went up to almost 70 rupees in 22. And then, of course, now they are back to 60. But if you look at 60 compared to 39 or 38. It is still 50% higher than what it used to be. But if you look at the price increases, industry has never been able to pass on this cost increases because on one side, if suppose some price increase is made, on the other hand, the discounts have been going up even more. Therefore, the industry has been suffering for last few years as far as the pricing is concerned. Therefore, you will see that there will be continued improvement in the transaction prices. Discounts will come down and the pricing also will go up slowly and steadily. So I don't see a lull in the price increases, even though the inflation as of now is not much. But at the same time, because we have not been able to recover our cost increases in the past, I think the industry will see some better transaction pricing, whether it is through reduced discounts or whether it is through slightly higher prices.
So give us a sense then in terms of the outlook for the next year, keeping in mind the budget, keeping in mind the elections. Do you think that we can see the year 2024 emerging stronger than this year?
Yeah, next year should be even better because definitely the industry is going to do well, economy is going to do well, and there is a lot of hope that the Indian economy will grow further from $3.7 trillion. It should go up to $5 trillion in next 2-3 years. So based on that, the CV industry is slated for a good growth based on the good potential in the economy.
All right, good to know. And on that positive note, we'll let you go. Thank you so much for taking time out and giving us a viewpoint as to how the industry is shaping up as well as the company. But let's get a move on and put the spotlight on the ET Now exclusive news break with respect to the Zee-Sony merger saga. We understand that the fate of the merger is going to be decided this week itself, and ET Now has learned from sources that the dispute over the CEO has to be settled soon if the merger has to go through. In fact, we understand that the SAT has cleared Puneet Goenka to be the CEO of the merged entity. But let's understand what exactly are the details of this. We've got Ankur Mishra joining in with all the exclusive details. Ankur, what are you picking up?
Yes, sources say that a key decision on who will be the CEO of the merged entity of Zee and Sony is likely to be taken this week. In fact, sources have informed that a key meeting between the two parties is likely to be held this week, and a decision will be taken that who will lead the merged entity. Remember, there was a dispute between Zee as well as Sony because Sony has pushed its India head NP Singh as the CEO of the merged entity. However, Zee is continuing to say that as per the earlier agreement, Puneet Goenka should be CEO. However, Sony has been pressing the fact that since there is a pending investigation against Puneet Goenka of SEBI, and therefore the merger should not face the brunt of it, and hence its India head should be the CEO of the merged entity. Now, while this decision needs to be taken soon, we also understand that after that the committee is likely to take this forward to the Information and Broadcasting Ministry for approval, and an application at ROC needs to be filed before 21st of December, which is a key date where this merger needs to be concluded as per the agreement which had been signed earlier. Also, there has been separate petitions which has been filed at NCLAT against the NCLT approval which has been obtained for Zee and Sony merger, and we need to wait and see that if at all any legal hurdle is remaining for the case, maybe deal breaker for the case.
All right, the deadline fast approaching, December 21st, and that is the latest that we are picking up with respect to the Zee-Sony merger and the CEO dispute. Thanks very much, Ankur, for giving us those details. The stock price at 257. But tell you what, we'll take a very quick break. Stay with us. On the other side, Shalabh Saxena, MD and CEO at Spandana Sphoorty, joins in to talk about their business. As promised, we've got Shalabh Saxena with us of Spandana Sphoorty. Let's talk a little bit more about their growth outlook, view on asset quality, as well as net interest margins. Good to have you on board. Thanks so much for joining in. Now, given that you had earlier spoken about, a sort of a vision for the year ahead for 2028, you had hinted into that. Can you give us a little more perspective? Put that down to numbers. What exactly does that look like in terms of your growth projections?
Morning to you and all your viewers. First of all, about 6 quarters back, we had come out with a Vision 25, which articulated a very clear view on we as an enterprise, where are we going to exit next year, end of next year. To your specific question on the Vision 28, it is still in the works, and I think we should take another 2 weeks, a week and a half to kind of crystallize. Once that is done, then we may want to share it with all.
In the light of what we've heard from RBI for unsecured loans, for the category which you represent, which some would also argue that has a deep dependence on the unsecured borrowing, do you see there a concern which could brew up? It may not be for your firm, your company, but it could be for the sector per se, because Reserve Bank of India, at the vantage point they're sitting, they have access to a lot of data which you and me don't have.
It's a fair point, and I think what is being steered is a bit of a moderation, Nikunj, in my view. There's always, whenever you go in hindsight, you go back whenever there's a regulatory intervention or a nudge. It's always good for the larger cause of the industry. To the specific point on microfinance and PSL, while yes, it is out, but we are also cognizant of the fact that we need to be cautious, and accordingly taking all steps to ensure that we moderate and calibrate the entire growth story of the industry and the company.
There is a feel-good factor which seems to be coming back in the rural economy now. It's a feel-good factor. It has not translated into any real uptick so far. But when we spoke to HUL last, or the indications what we've got, let's say from auto companies, they're saying that the rural economy is coming back. Now with the election inside, government spending is going to increase, rural economy is going to benefit. What does that mean for your business?
Nikunj, this is the last mile delivery business where even for a complex country like India, where the distribution is very, very, very far and it is deep in the country, in the rural country, for the rural India that we are talking about. Any euphoria is always good. However, what we are experiencing over the last 2 to 3 quarters is some bit of moderation from the time when we came out of COVID as a country. So, which is good for the industry if you were to ask me, because it's very important that this unsecured lending to the bottom of the pyramid is, it kind of works one step at a time and not really jump the whole hop. So, to that extent, what we are picking up is a bit of a standardization or a moderation, as I would say. On the quality side, things have stabilized and it is on the improve. So overall, at a framework level, we are seeing some bit of stabilization. Not really, maybe about 3-4 quarters back, we were slightly, as an industry, we were slightly, going at a slightly faster pace, which now I think things have moderated. To your question in terms of how does it augur when there's a continuity in the political establishment and a lot of investment in the infrastructure structure. I think we've seen the income levels of our customers rising because of all of the things that you've mentioned, and I think the going should continue to go. I mean, it should move in the right direction over the coming quarters and years.
Graphics here, and that it's remarkable. Collection efficiency, NPAs and your AUM. 6 quarters. We have the 6-quarter data. It'll just come up. First, let's look at NPAs. Then let's look at AUMs. What you've done is you managed to bring the NPA levels down and you managed to take the AUM higher. Do you think a lot of easy, low-hanging fruits have been plucked, which is that you've been able to repair your book because what you inherited when you took over was essentially inefficiency, which you managed to pluck. You managed to grow your book, but that was largely because of the base effect. So do you think, if I may use the English term, the low-hanging fruits have been plucked now?
So, Nikunj, low-hanging fruits in a unsecured is a bit of a, always a contradiction, because even while they are the so-called low-hanging fruits, you still have to be very, very cognizant of the risks which are associated in managing this business. I have been maintaining that this business is not about assets. This business is all about managing risks. So in that context, yes, to most of the questions that you said, so we cleaned up the book, we got the management team in place, we've rejigged our model to an extent. There's still some work unfinished, which will take another 2 to 3 quarters, but we are broadly there. And at the same time, we've been able to kind of reasonably capitalize on the opportunity which was available in the market. What we've been as a team very cognizant of is that we really balance this whole trajectory, and we kind of ensure that we really don't go overboard. So asset growth coupled with managing risks is what we're concentrating. We've been Nikunj, highlighting that loss rate of sub of 2%, NIMs of anywhere around 12.5, 13 to 13.5, and a steady growth rate at an AUM level now that the number that we are, AUM growth of anywhere around 25% is a very much doable thing in the next couple of years.
Okay, and I just wanted to also understand that given that 44% of the funds come from banks, 20% over 20% from NBFCs, I just want to know what the outlook is in terms of what you're going to do to offset any cost of funds pressure. Are you going to look to pass that on?
At this point in time, from whatever we've heard, and given the fact that all our entire business is PSL-led, we haven't seen or heard any impact either from the lenders or even otherwise. So as far as the cost of funds is concerned, I think we as an enterprise have peaked out on the cost of funds. Assuming the repo rates, etc., to kind of go in the way we are going, as a country, I think we are fine. Another 2 to 3 quarters, if we see things stabilize, we might look at probably passing on the benefits, not the other way around, passing on the benefits to the customer.
Run this tight ship of this current tight ship without raising capital?
Yes. So until exit of next year, as per our calculations, we should be around 25-26% CRAR. Currently, we are at about 37%. So we are good on the capital liquidity. Nothing until next year. Once we hit in the neighborhood of about 25%, we might look at a growth capital, but that's still, it's early days at this point in time.
Exit of next year means next financial year, I would imagine, right? That's FY25.
That's correct.
So 15 months, you will at least 15 to 16 months, you will not look at raising capital.
Correct. That's correct.
And when you see a large election cycle play out, psychologically, what does that mean for perhaps the unsecured loan category? I mean, do they delay their borrowing? Do they extend? I mean, how does it work in terms of the borrower psychology?
Look, Nikunj, this industry now is a 2.5-decade-old industry. So we've gone through multiple cycles in terms of, issues. If I go back about 10, 12, 13 years back, the situation then to now has changed dramatically. From a maturity point of view, the market has evolved. And when I say market, it includes the financiers and it includes the customers. So people earlier, during the election, people used to think that, there'll be a promise of waivers, etc. All of that is a thing of the past. At least to what, when we hear our customers, and there's a lot of awareness which has gone from the industry into counseling the customers that this is a loan which doesn't really attract that so-called waiver, if at all there is an announcement. So there's a sufficient maturity at a customer level that we have experienced, and hence there's a lot of stability. Elections come and go. We've just seen elections in the 4 states. Nothing really to worry about is what I would say, because of the reasonable maturity in the environment.
Okay, fair enough. Thank you for giving us that clarity. Good to have you on board and giving us a sense as to how overall business is shaping up for Spandana Sphoorty. Just a quick check-in on the markets and holding out pretty steady at the current juncture. And in fact, it's the broader universe as well that's holding its head up high, along with, of course, the frontliners quoting at those record levels. Adani Green comfortably in the green. You've got Prestige Estates, Bharat Electronics, REC, and Ambuja Cements. Those are all the stocks that are holding out in the green. But let's take a look. I'm actually on the Make My Trip website right now looking for a flight to go to Goa during the New Year's weekend. And if I wanted one, I would have to share out quite a significant amount of money. Rajesh Magao is now joining in. He's a co-founder and group CEO at Make My Trip. And really, the rates for the New Year are skyrocketing already, if I may. I just want to understand what you would attribute this to. Is this that, year-end wave that's very typical of every year, or are there any other factors that are leading to this?
Yeah, good morning. Good to see that you sort of already looking at planning for your holiday on Make My Trip. So hopefully you'll get the right fare as well. But part of it is, by the way, business as usual. I mean, this is the time when everybody sort of looks to plan for annual holiday. And then there are, long weekends coming. There are actually 2 long weekends this time around. You have Christmas long weekend and you have New Year long weekend. It's generally speaking, it's a celebration time, and it's the time when it also coincides with the school holidays, etc. as well. So a lot of people actually end up planning for holiday right now, during this time. And Goa happens to be the most popular destination. So I don't think we should read too much into anything more or unusual happening here. A lot of it is actually usual. It happens every year. What might be different this year a little bit on top of it is that the overall sort of consumer sentiment for travel is bullish, and more so post the World Cup euphoria. A lot of the season which we typically have between October to December, the first half of that season was all World Cup, and we were getting the upsides on World Cup destinations, although limited, because wherever India was featuring in the game, that you would see the upside on those particular destinations. But outside of that, on the weekends, everybody else was sort of on the TV, watching the matches over the weekend at home as well. Now that has changed significantly. Now suddenly, the momentum has picked up in terms of just the leisure planning, just taking a break, just doing your annual leave, celebration, and so on. So because of that, there will be more rush. We have seen that happening on our platform. Bookings, growing. Even this like-to-like comparison, if you do it with the last year, good about 20% for the same sort of booking window. Let's say from 15 December to 31st December. So that might be the new thing that is sort of adding to the momentum. Otherwise, it is a regular season.
How does your business model work? I mean, higher prices means more spreads for you, or you will get fixed spreads irrespective of the pricing?
So good question, Nikun. It actually varies from which segment of our business that you typically look at. So if you look at on the hotel side, it will be linked to the pricing. So it will be our sort of margin will be directly function of the pricing as well. But if you look at the flights business specifically for domestic, actually even for international flights, a large part of that could be a fixed fee. So it doesn't really, so for flights, part of our business, which is good about 40% of our business, will be volume linked, and another 50-60% of our business will be value linked.
As more and more competitive intensity increases in this space, as more and more AI tools they kick in, what would be your mode? Because ultimately your whole interface is AI driven, customer interface, and pricing, which is perhaps a function of the credit card or perhaps the backend deals you have. But AI in a sense could really bulldoze everything.
Yeah, no, I think it's an interesting observation, and I think we should look at it not necessarily, when it comes to AI and the implication of AI and the use cases that will impact, not necessarily at the 30,000 feet level. We should go deeper, and which is what we've been doing. So our model is actually tech enabled at the core. So every new technology, we are always at least try to be always sort of ahead of the curve in terms of just leveraging the new technology that would be coming in. And specifically on AI, for instance, that we've already sort of, implemented about 3 or 4 use cases to enhance the customer experience significantly. So I would say, any technology over the years, there have been many, many new technologies that have been coming in, and for a technology-led business, it's always good to be sort of see that coming early and then invest behind that, and fundamentally try to enhance customer experience. Some of these technologies would also give you productivity gains at the back end, but that's not necessarily the prime gain. The prime gain comes from the what you are able to do it to make customers' life easier, whether it's a personalized experience, as you were mentioning about it, or it is just to, take the customization of the experience to a different level, or improve, let's say, the after-sale experience for the customer, and or just to improve the content that you sort of render to the customer, which helps on the customer journey. That customer can take the decision, which is far more informed, and so on. And that has been the focus. And one important thing that I think, which is very sort of critical to also link it with the AI technology or machine learning for that matter, is the data underneath. So the data is the one that is sort of making all of this happening, right? So this is the layer on top of it, but what you end up sort of using and leveraging is the rich data, and based on and leveraging data science and engineering, you build those models, and then you apply artificial intelligence and now generative artificial intelligence to get the best possible sort of result for the customer. So that is what it is. It is going to be at the helm, but I think the key will be how best you sort of pick up the use cases and then leverage this technology to improve the customer experience more than anything else.
Rajesh, I think what anyone wants to know right now is whether there is a cheat sheet or a trick code to beat AI and get the cheapest tickets on MMT.
I know. Well, I wish I could sort of say that, we end up sort of controlling the price. Eventually, the price has to come from all our partners as well. But I'm sure you would be able to sort of, if there is a little bit of a flexibility and you're not necessarily rushing in to only catch the same long weekend that everyone else is catching, I'm sure you'll get the good deals. And, and if I may sort of add, what interesting thing that we have also picked up this season, because as you would probably recall, that a lot of the travel was happening in the domestic market. It was mostly India travel because, historically we were going through COVID, and international, there were many teething issues, visa-related issues, and the fares, etc. And now that market is also opening up hugely as well. Thailand announced the ease of visa for Indians. Even Malaysia announced it. Now a lot of that is getting picked up by the customers, and then people are just now sort of getting more bullish about international travel. So this season we will see a lot of international travel picking up as well.
I'm going to also encourage, Mayur Milak to join in to take this conversation forward. So Mayur, let's look at this question purely from a standpoint of somebody who wants to say, okay, I went on a booking portal and prices have been exorbitant. I went on a hotel website, prices were sky high. Now, as a customer, I may be feeling a pinch, but as an investor, is it time to, let's say, buy some of these travel platform companies, aviation stocks or hotel stocks? Mayur.
Yeah, hi, morning. Yeah, so, clearly, yes, Q3 any which way is one of the best quarter for the aviation industry. If I look at an Indigo, so, we've just seen the correction in ATF beginning of December as well. So now if I just compare this quarter's fuel cost vis-a-vis the earlier quarter, you're up by about 10% maybe. But your fares are up almost by 20%. So it clearly gives you a very strong edge on profitability. And I think with the kind of scenario pricing power that these guys are sitting on at this point, clearly a very strong buy.
Okay. Mayur, the conversation what we are having is that, look, this is nothing unusual about this holiday season. It is pure demand dynamics which happens every year. It's just that when they stare at you, you think it is something different. So my question is that for somebody who's watching the show, is it time, let's say buy an aviation stock or a hotel company or a hotel stock? Because that's how you try to connect dots. Mayur?
Yeah. So yes, so we have our official coverage on Interglobe Aviation. We have a buy rating with a target price of 4,000. We clearly think this is a great time for the aviation industry to make money. You've seen a very strong correction into crude prices, clearly will reflect into profitability going forward. And the demand has been very steady. We are still doing almost 4 lakh plus passengers on a daily basis. So demand has not been disrupted despite the increase in fare prices. And these guys have not reduced anything, despite a significant correction into the crude prices. So clearly profitability will be very high. Yes.
Rajesh, lastly, I want to ask you, besides Goa, which we fleetingly discussed, what are the top 3 destinations, domestic ones, of course, that everyone's been queuing up for?
Yeah. No, I think it's a great question as well. So Goa, of course, remains the hottest, especially during December season. But there are many others. Actually, it's not only Goa, and that is one of the sort of emerging trends as well, that people are very willing to sort of explore new destinations and not necessarily keep going back to the same destination. And in comparison to, let's say, your Manali or the Nainitals or the Srinagar or Goa. And these are all usual destinations. People who want to go and watch the snow, they would go to the hills. But within the hills, then the people are also preferring a lot of the exploring the Uttarakhand side of hills as well. And down south, by the way, there's Cochin and Coorg, which are very popular as well. And on the east side is Darjeeling, that is also very popular as well. So it's actually it's a very good spread that we are seeing. A lot more exploration of the destination and the newer destination that are sort of getting more share. And then maybe because of the fact that, if the repeat travel is happening and people would have visited, the main destinations already, and therefore they want to explore. But we do see, different cohorts, with the young cohorts or the youngsters or the millennials, etc., more willing to just completely explore unexplored destinations. So very sort of widespread, I would say. Even Pondicherry, Mysore, Udupi, Gangtok, etc., are also sort of featuring in when we look at the overall bookings on us.
All right. Rajesh, really appreciate your time. So glad you could join us. And it's December first week. We'll perhaps connect with you a little later to understand that, has the pecking order changed really in terms of December 2023. But my last question to you as well. You have a buy on Indigo. Now, historically, we've always learned, maybe by reading Buffett or other global investors, that aviation sector is a tough sector to invest in. They rarely make money. Lost me. Let's take a break. Indigo 2820. Whatever things we are saying for the aviation sector, well, the stock is telling a different story. It's not been a great year for crude. It's not been a great year for ATF prices. It's not been a great year for Indigo also, because a lot of their aircrafts in a sense have got grounded because of the Pratt & Whitney engine issue. But in terms of the dominance, market share, profitability, what they've reported for the quarter gone by, where they're looking at expanding their trunk capacity. Now they've got both Boeing and Boeing and also Airbus. They've already started flying global, and now they would be going globally as well. I think 2 months ago they've ordered one of the biggest aviation order, and they are talking about a growth of 15 to 20% or 20 to 25% for the next couple of years. They're almost looking at tripling their capacity in next couple of years. All that factor put together, and the fact that the dominance where Go Air is under, SpiceJet is a bit shaky, with 63% market share, doesn't matter how many of your aircrafts are grounded. I mean, you are in for a very, very strong altitude gain. Let's take a break. Markets under pressure. What has reversed on expected lines? Tata Tech IPO. It was a blowout listing, but just after that blowout listing, there seeps to be a mid-air turbulence there.